So tonight we are live on Facebook and we are on our Zoom channel. We did this 2 weeks ago. This is our Multifamily Masters Live. We have an absolute team of hitters talking this evening. I will let them introduce themselves here in a few minutes. Who are we? We are Multifamily Masters. What are we? We are in the process of building the world's largest multifamily cash flowing platform. And how are we doing that? We have a Facebook group, multifamilymasters.com. If you are not in that Facebook group, search for it right now, and hopefully somebody will put it in the comments on Facebook and the comments here in the Zoom link. We have approximately 70 plus meetups around the world, furthest one away being Hong Kong. With that being said, our platform is constantly growing. COVID has slowed it down a little bit. We decided to go ahead and launch this Multifamily Masters Live. We do it every other Monday, 8:30 p.m. Eastern. And we have 101 participants on the call right now. We had about 400 people sign up for this call. We're expecting a pretty big turnout, awesome group of individuals. Let's see, a little bit about us. I mentioned the Facebook group. We have a YouTube channel. We have a mastermind. If you are looking to learn, share, network, and grow this business in the right way. I have two of the best business partners in the world on this, Mr. Faris Musa, Mr. Pao Chi. Between the three of us, we control, own, operate approximately 3,000 apartments, and we have decades of experience. But tonight, we're here to learn from an absolute group of hitters that have a lot more experience and do a lot bigger deals than what we do. And I'm super happy that they're here. And I'm gonna let Faris and Pao to go ahead and take it off.
Sure, real quick, I'll introduce myself and then Faris will get into it. So my name is Powell Chi. I'm the founder of this group. I started about 2.5 years ago with just a small group in Manhattan Beach, California. Since then, the group has grown up to, I don't know, we're at like, what, 70 chapters now or something, Garrison? I don't even count it. We have a lot.
Right about that number.
Yeah, so certainly grown really fast. I like to say, Garrison said, we want to grow to the world's fastest. I like to say we're the universe's fastest growing multifamily group. So, we like to have fun and things like that. I myself, in terms of real estate investing, been investing in multifamily for about 3 years. I have about 1,000 units that I'm in the general partnership of. And, that's a little about me. Pass it over to Faris.
All right, so I'm Faris. I'm going to be the moderator today. I'm based out of Houston. I don't like boba tea nowhere near as much as Pal does. So for those of you who don't know Pal, he really likes boba tea. That's what his background is behind him. It's not just happy faces on cups. But for me, I'm a managing partner of a company called Disrupt Equity. We have properties, we have about 1,500 units throughout Texas and Georgia. And yeah, as Garrison and Pal mentioned, we kind of help run the leadership of MFM, as well as we have 3 other partners as well that get involved as well. So Bethany, Kyle, and Qual. So definitely, shout out to them as well. I think we forgot that last time, but they're a big part of this effort as well. And so I guess with that said, I'm going to go ahead and kick it off. And so, I think. Hey,
hold on 1 minute, Faris. With that being said, Bethany's a huge part of this. But secondly, now that we're being recorded, I just want to give everyone a heads up that this is being recorded. We will be sharing this on YouTube tomorrow. It will be recorded, so anything you say, just be aware of that. Sorry about that, Faris.
All right, now I got to be careful what I say, man, if it's all recorded. And but yeah, so with that said, definitely excited about our panel this week. It's a bunch of friends of mine, so that's good. So definitely been wanting to put this together. COVID is kind of forcing function to really get this into a kind of every other week cadence. But we do have a good panel. I'm excited to kind of run through stuff. But really for today's panel, we want to do it a little bit different than last time. Really want to make it a little bit more, interactive between the panelists. So don't feel like it's a moderation type thing. We'll kind of help facilitate, but you guys are more than welcome to chime in on each other. Ivan can share his bad ideas. Kenny can share the bad ideas. We can talk about the good ideas and everything in between, right? So that's kind of the style. And we're going to run until at least 9 o'clock. So probably after about 45 minutes from now, we'll do a breakout where we'll split the group up into kind of sessions, right? Where, we'll do breakout rooms is what we call it. And we'll do that for about 10, 15 minutes and let people get a little bit more one-on-one interactivity with the panelists. And then, we'll bring everyone back together and do a debrief and call it a wrap. So we'll try to be done by about 9 Central. And so that's kind of the time schedule. But with that said, I'm rather than me introduce the panelists, my introductions are a lot more boring than theirs. They know themselves much better than I do. And so to kick it off, I definitely want to have everyone maybe run through and give a little bit, like a 30-second background about you, your company, and maybe what you had for lunch today. Make it a little bit interesting. So Ivan, I know you're chomping at the tea, so let's let you kick it off.
Hey, thanks. Cheers, Multifamily Masters, Powell, Ferris,
Awesome.
Garrison, and Bethany. Thank you guys for putting this together. Thank you for having me on. Honored to be here. As Ferris said, I am chomping at the bit with a little tequila here. My name is Ivan Barrett. I own and manage 3,000 units in the Midwest. My company, BAM, is 90 employees. We're north of 300 million in assets. A couple more deals under contract should put us at close to 3,500 units. And I started house hacking a duplex.
All right. What about lunch?
Lunch. I've been eating trifecta meals as part of my training routine. I get these pre-packaged meals that I get them every week. And I take them to the office. They're the blandest things I've ever eaten, but if you put lots of hot sauce, salt, and pepper on them, they're quite digestible.
And it helps with those Ironmans you're trying to do, right? So. All right. Next up, let's let Raj. You want to go next?
Sure. Thanks, Ferris. I appreciate the invitation to be on the panel tonight. My name is Raj Gupta. I live in Naperville, Illinois. It's a suburb about half an hour west of Chicago. I'm the co-founder and managing partner of Impact Prosperity Partners with my partner, Anna Simpson. We own about 1,800 plus units as GPs and about 125 million plus under management. I've been doing real estate investments since about 2008 and focusing mostly in the Dallas area. I have a property in Houston as well, but we primarily focus on DFW.
All right. And lunch, come on, guys. You guys.
I had a skillet. Here. I had breakfast for lunch. It was a skillet.
I love that. Late lunch or late breakfast, I guess. All right. Yeah. All right. I'll let Kenny. Kenny's got a big grin, and I know he's got a unique lunch, so I'll let him kind of go through it. You want to go ahead next, Kenny?
Hey guys, thanks for having me, guys. Appreciate it. Good to be here. Good to see all these guys on the panel too. It's been a while since we've hung out in person.
I know, it's been too long.
Good when we can do that again. So just quick about us. I'm Kenny Wolf, founder of Wolf Investments. We started out buying multifamily 9 years ago. We've been involved in over 4,000 units in 5 different states. So have real estate, will travel is our mantra. So right now we're in Texas, Oklahoma, Louisiana, and Ohio. Multiple markets in Ohio and Texas. We also own our own management company. And then we're about to buy another management company in Ohio, bringing everything in-house here probably by July. So that's kind of a little bit about us. And then for lunch, I had, I'm vegan. So I had a big salad and then had some chicken, barbecue, coleslaw, things like that. And
chicken was trademarked.
Yeah,
chicken. That's real chicken. Come on, Kenny.
So, yeah, you know it.
All righty.
I just got to say, Kenny, have you had those Beyond Burgers yet? Those are amazing.
They are good. And Impossible and all those.
Yeah, I like those.
Wait, I don't know if I've ever asked Kenny this. Between Beyond and the other one, what's your favorite?
Impossible Burger.
Impossible, thank you.
I am Team Impossible myself. So.
Oh, maybe I'll switch now because when Kenny speaks, I listen.
The way it should be. All right. Let's see, Jason, you want to go next, and then Glenn can
Sure.
grab us home.
Yeah. Hey guys, Jason Perro. I'm based in Erie, PA. My wife is my partner. We've been buying property since 2001. We started with a duplex, started syndicating a couple years back. So we're right about 1,000 units. 2/3 of that we own ourselves with no partners, and 1/3 of that we are GPs in some deals that we syndicated. Happy to be here. I appreciate you guys inviting me. For lunch, I had breakfast for lunch. Bacon, eggs, and toast. Nothing
Amen.
fancy.
So I'm seeing a trend. I mean, it's a group of people that start off their days late, man. It's kind of lunch is breakfast, right? All right. And Glenn, you want to drive us home?
You bet. Thanks, guys, for putting this together. I have to say I've been on stage with a lot of you guys, and I just love the energy that you guys have. So I feel honored to be part of this. So thank you very much.
Thank you for coming.
Yeah. So I'm in Austin, Texas. I'm actually sitting on my back porch right now. Pretty soon there's going to be fireflies floating in the background, and the crickets are going to really get loud, and the frogs. So been in the industry for 30 years and started off in property management. Actually started as a maintenance man. You guys knew I wrote my book, Maintenance Man to Millionaire, and had about 4,500 units and started selling a lot of those in 2017 and 2018, and then finished up selling some in 19. I'm the CEO currently of Obsidian Capital. Yay, shout out with Dave Tupin and Mike Woodfield. And love everything about multifamily. I've touched many pieces. Had a property management company that I sold about 1.5 years ago. So I know you guys are acquiring them. I sold mine. So, it'll have lots of different perspectives on this call. So that's my story. And for lunch, I had Chipotle with chicken, and it was fantastic.
Did you use the Chipotle sauce? Because that's the best part of Chipotle.
Yeah.
All right, good. All right, so that's a little bit of background. Thank you all. So maybe to kick it off, really with the elephant in the room, I want to kind of dig in. What's everyone kind of seeing in terms of COVID? What are you changing operationally, if you're changing anything? How are you seeing collections? And maybe the other part of that too, what are you starting to see on the acquisition side? So that's kind of maybe the area I want to really focus in on for the next 10, 15 minutes. And I'm just going to toss it out there. I'm not even going to pick on anyone. Who wants to kind of hop in?
I'll go first. I've been pleasantly surprised. Our occupancy is still doing fairly well. As a matter of fact, from March to April, ticked up about 0.5 point in occupancy, which surprised us. And we've collected about 93% of our rent on the properties up in Dallas. There's properties down in Lake Jackson that aren't doing as well. That submarket south of Houston. So that's been very interesting and surprising that we've done okay. As a business, we've decided not to take advantage of the forbearance on most of our deals that Fannie offered. And then on the acquisition side, we've seen some of our investors kind of sit on the sidelines. So it's taken us a little bit longer on the raise on a couple of our deals. So kind of in a nutshell, that's my opinion.
Anyone else?
Yeah, I think, so we self-manage all of our properties, and, the thing I love about real estate is it's the most recession resistant area you can be in, especially in a tertiary market. So we're in Erie, PA, and it was like nothing happened. I mean, of course, everybody's under lockdown and not going anywhere, but collections are great. We're filling units probably faster than we usually do. What I found with this crisis is it's forced us to do things we should have done years ago, like move all of our everything electronically, just become more efficient in operations. So it's honestly been fantastic. And we figured out how to really kind of make everything lean, mean, and run really efficiently. On the acquisition side, we're midstream on a couple deals. We had sent out an email on Friday, March 13th to our investors for our next raise. And the next week, everything kind of shut down here. And surprisingly, we raised the money in 24 hours from an email, and everybody stayed committed. And the interesting sort of aside to that is that all these investors are asking to increase their investment. And so the problem is we don't have enough deals to go around right now. So that's a good problem to have, but I think it's been, but Fannie Mae and Freddie Mac have been, the agency debt. I mean, they want, 12 or 18 months of reserves, which is fine. So it just takes another level of underwriting and planning. And I think some of the questions they're asking are a little bit deeper and more difficult, but that's fine. We have our boots on the ground, ear to the street with our units. And so not really an issue here, but it'll be interesting to see how it all plays out with folks that have asked for forbearance. I think the lenders have a long memory, and even though they say they'll do this without penalty, I think that's a road you don't want to travel down unless you really, really have to.
Right.
Nice.
I guess what I'd add real quick too on the operations. So yeah, the collections have been good. We've seen a lot of traffic and people leasing units moving in. And then also too, with all the kids being home, we saw a lot of our bigger units, our 3 bedrooms, move faster earlier in the year than typical, Because usually those wait till like April, May to really start leasing out. We were leasing those in early March, late February, you know, to some of the.
And on that note, has anyone seen a slowdown in leasing? Because we haven't either. And I have a theory, at least that came up in another panel I was on, but has anyone seen a slowdown?
No, we're seeing record leasing, and we're seeing two groups. We survey all our managers. We're like Kenny and Glenn. We manage everything we own. We're seeing residents moving down from luxury, just a few more at each property, and then we're seeing also a few more at each property. Folks that have decided not to purchase a home this year that are looking to rent. So our occupancy's up almost 2 basis points in 45 days here. And collections overall, I think we're at 93. And then the last 2 years, we've been buying a little bit nicer B+, A- vintage, still $500 to $1,000 below new product. And there we are 99% collected this month and 97.5% occupied. I'm getting ready to raise rents.
Yeah.
Right.
That was we've been seeing, so the theory came up, and this came up on a webinar I was on with Neil Bawa. And basically, my thought originally was that we're still leasing, whereas other apartments may be shut down. And so people that are looking to move somewhere, right, we're one of the only options, right? That's what I thought was part of it. But then Anna brought up a good theory, which is you have a lot of couples that are stuck together. They might be bickering and one's looking for a place. You have people that lived with their parents, right? And then now they're working from home, they need more space. They might be going and leasing. There's a lot of interesting dynamics to think about. But one of our deals, we get our Monday reports, and one of them literally hit 100%. We've never been 100% on that deal. So it's been surprising.
Time to raise rents, Ferris.
Yeah, no, that I was literally, as I told them, like, hey, we kind of missed the boat on that. So
we kind of started pumping the brakes a little bit on the renovations at one of our properties in Fort Worth on Cobble Hill. And the manager called and says, hey, we're getting a lot of questions where people want these 1 bedrooms and they're willing to pay the renovated price. So we actually took our foot off the brake and told the contractor, if you're comfortable getting in there, keep renovating those. We were really nervous that we wouldn't be able to get the bump, due to people not willing to pay. But again, that's back on track. So interesting enough.
I think the punchline is for us guys is that, our apartments they're reasonably priced. They're right behind food and shelter in the hierarchy of needs.
Yeah.
Right. And the Fed and the Treasury has said, we're going to keep sending checks to everybody until this thing clears. We're in a pretty darn good position.
Right.
And on the deal flow side, it seems like there's more opportunities to pick up deals. I can't wait to tell you guys all this because I've just been giddy about it. For the first time, don't tell anybody else though. For the first time since
me and my 140 friends will listen.
For the first time since 2016, maybe 2015, we got a deal under contract, 0 hard earnest money.
Wow.
And I'm talking about a $25 million, 200 unit deal, and I'll just say in the Midwest.
We've been seeing, it's been interesting. It's I've seen 2 parts to that. I'm seeing similarly where I know we can get that, but then I've had a broker literally call me and say, hey, the seller wants 200 down, hard day one. I'm like, that's not going to happen.
Yeah.
Is there anyone else
Yeah, I think, my experience has been similar to the rest of you. The traffic has been really, really strong and collections have been really good as well. My fear is that a lot of it, I think, has to do with the government programs and support. And so, we got the PPP, so people were by design not laid off, although a lot of people obviously were. Yeah.
You don't like QE Infinity?
Oh, I'm not saying I don't like it. I just don't know if it's going to be Infinity. Look, we all benefit.
He likes it, but he doesn't know if he should like it.
Yeah, exactly.
Hey, listen, I'm not saying it's the right move, but if you own income producing assets that people need to live in, it's not a bad spot to be.
Real estate's a good space to be in, with that. So.
I think there's going to be competing forces, right? So if if the recession continues, which I think it will, there will be homeowners will be foreclosed on eventually, and they will become renters, and that's going to create some demand for multifamily. So I think, that's a good sign. But I'm also afraid after 8 weeks and the PPP program runs out, unless Congress just keeps passing more and more stimulus, which they might, right, for a while.
They're voting on it.
But at some point, that's probably going to run out. The deficits are going to go. I mean, they're already ridiculous. And there's got to be an end game there at some point. It may be 6 months from now. I don't know. But and then I'm afraid that, what we're seeing in terms of traffic and collections may reverse course. And so I think there's just a lot of unknowns right now, but I don't think we should overgeneralize maybe what our experience has been in April and May, because I think things can change pretty quickly.
It's definitely, I'm not gonna lie, April and May were surprisingly much better than I was expecting. I was expecting May to be worse actually, and it's just been skyrocketing. So we'll kind of.
Are there any panelists that have some A property that's doing well or not doing as well? Because I think one of you mentioned some of them were moving from the A to more affordable. But does anybody have any A properties?
We do. We've got two, soon to be 3 A class. We're buying they're more your A minus. They're not the ultra high end stuff. But we're seeing record collections in those. We have a 176 unit A class here in Dallas Fort Worth, and I think our delinquency for April was like $1,000 over 176 units. So it's kind of similar to the B plus space where they still had a job and things like that. So
I'll give you
I'm in the same boat, Kenny.
176.
Huh?
Go ahead.
I'm in the same boat as Kenny. I call it an A minus. Some might call it a B plus. But we're 1990s, early 2000s vintage. We're still well below luxury, but we're a little bit of a step above, and we're in the same boat. Collections are like 98 and change % collected, and traffic has fallen off a cliff, but everybody coming through the door converts.
Right.
So we're seeing like 25% of the people, but we're getting, say, 75, 80% converted to lease. And when I say coming through the door, I mean mostly it's electronically, virtually these days.
Yeah, I've also seen fewer people move out. So I'm taking less notice to move too. So I don't know how you guys are seeing or what you're seeing.
I'm actually curious. What have you guys been seeing? I'll chime in.
We had a bunch of people cancel their move-out notice.
Yeah, same here.
Yeah.
Are you all seeing a difference in the quality of the traffic that's coming in? Are you seeing a decline, or is it pretty much the way it's always been?
For me, it's the same traffic. It hasn't moved. I mean, I still have the same people that need to be denied. Ironically, I've had a few people on the delinquency side that put in and said, hey, I need to, not pay my rent because due to COVID, but they're sending it from their work email. And I can't figure that out. So we've got to figure out a response to trying to take advantage of the landlord not evicting. So, I am seeing some people trying to do that, take advantage of the situation.
Speaking of, I did see an article today that I guess the Texas Supreme Court said the eviction courts can start up again this week, I think, or next week. So
go Texas.
Yeah. So I mean, that kind of leads to a question that I was going to ask. Does anyone have any properties in non-Texas friendly states? Sorry. We're all Texas friendly states and non-tenant friendly states. The other team were.
You mean landlord friendly?
Yeah, that's probably that are non-landlord friendly states. Sorry. It's been a long day.
So Pennsylvania is so PA is kind of middle of the road. It's we're not having rent strikes here, but it's the evictions are on hold until July. So it's a little bit of a tough pill to swallow if you have somebody you really have to get rid of. But one thing I've been pleasantly surprised about is that people that were kind of on the fence, really struggling, that we thought we'd have to evict before, they're using their stimulus money and unemployment money to catch up their back balances. And I was kind of shocked at that. And even early on, a couple of people paid even knowing they could stretch out the eviction until July, paid their back balance and got back on track. I don't know why. I mean, maybe, human tenants are better than I thought they were, but we're seeing a positive trend in that area.
We're doing a modified cash for keys where if somebody's really been impacted, they've got no job, and they've proven it, and they know they don't have to pay rent, because even in Indiana, a landlord-friendly state, we can't evict right now, but we're very upfront with folks saying, hey, listen, as soon as that's lifted, we'll file an eviction on you and ruin your credit, or just give us the keys. We'll keep your security deposit, move on down the road. And here's a letter that says we won't file an eviction on you. And so for the one or two folks at every asset that we own that have been in that scenario, it's been pretty effective.
Hey, do any of you guys have any student rentals?
Yeah.
I do not.
I do. I'm trying to sell.
I was waiting to see if Kenny wanted to mention it or not. I was gonna pretend like you didn't, Kenny, if you wanted to roll.
I do. Actually, I had interesting this week. We had 3 unsolicited buyers approach us about those assets. So we may get those offloaded here soon.
How has your student rentals been during the whole COVID?
I mean, the parents guarantee the lease, so they're rents are coming in. It was more of a concern about whether, and we're near Baylor University, whether Baylor was going to be, opening up their doors for fall. So it was really, so we already have a condensed leasing season anyways in student housing. But now it's really condensed because everybody was waiting to see if Baylor was going to open their doors for fall. They did. They announced it a couple weeks ago. So now we've got this even a bigger rush for renewals and new leases. But we're bumping rents by $200 a unit on some of those, 100, 150. So, I mean, the demand's there.
So did you have students come back and try to say, hey, because of COVID and Baylor shutting down for the spring, they want a refund or a renege or something like that?
No, because we're next to a private school. So it's like 60 grand a year to go there. So rent's not the most expensive thing for those folks. So we did it in ours. I heard some folks had an issue with that, maybe at some public schools. But
I feel bad for people that went to that school. So we'll leave that out.
We did.
That's the joke.
If Ferris, we did have some of our students come back and ask for that, but they signed a lease, and the lease was the lease. So we still don't have a problem. And the big concern is what's going on with the fall. Yeah. Because most of the rents were already paid prior to this coming out. The timing was good on that. We pretty much had the semester's rent. I did have a question, if you don't mind. Good seeing all you guys. I haven't seen you in so long, this whole panel.
Hi, Jeff.
But the question is, now we're getting about 93. We got about 93% of our rents collected. But I was just talking to the manager that we're low on all the other fees because obviously we can't do late fees and we can't do all this other stuff. So we noticed that overall collections were down, but we were getting about 93% of what we had out there. Any of you guys seeing that as well? Obviously you can't do late fees.
Right.
Yeah, for sure. We experienced the same thing. I mean, there's the other income has dropped because of that, not being able to charge late fees. But collections are still well into the 90s on most properties, especially in DFW. So that's been a pleasant surprise. And we've had a few residents that if they got laid off, we entered into payment plans with them, payment arrangements. And so that's something that our management companies have been actively engaged in as needed, case by case.
All right. That's awesome. Well then, anyone else have anything else to add before I shift gears a little bit?
I have a general question if I can ask.
Go ahead for this one. I think for all future, anyone has questions, please just go ahead and type them in the chat and we'll go through. After the breakouts, we'll spend the last 15, 20 minutes just going through open Q&A.
Okay, then I'll just put it in chat, so I don't want to stop your flow, Ferris.
No, go ahead. No problem on this one.
Oh, okay. So if you look at what's happening, right, stimulus is pumping out trillions of dollars. And I think a lot of the rent right now is being paid through the stimulus. Unemployment rate is at about 26 million or $30 million. 30 million. Unemployment is 30 million so far. So looking forward in the next 3 months, July through September, what's everybody's thinking here? Are they hoping that 30 million people will go back to work so now they can regularly pay their rent? Or are they looking, say, hey, 30 million is going to turn into 40, 50, 60, as long as the government's printing checks, printing money, we don't care?
Yeah, so that's pretty much the question I was going to ask. So it's going to change gears, and basically my question is, and I want everyone to answer it, and I do not want everyone to have the same answer. So, but really, the question, I'm going to say Chris's question a little different. No one has a crystal ball. What do you guys think the next kind of 3-4 months looks like, and what do you guys think the next, the following year looks like, right? So 12 months from today, right? And what, that's kind of maybe the high level thing I wanted to just see what everyone's thoughts were. And Glenn, I'm going to do it backwards. So let's you go.
Okay. I'll go first because that's the best part because nobody can say what I'm going to say.
Oh, wait. Actually, I made it too easy for you. No, I'm kidding. Go ahead.
But thanks. You're a good man.
Sorry, Ivan.
Actually, I don't want to be a wet blanket, but I'm very nervous, when I think about opening up restaurants and theaters and all that other stuff, but they've put such requirements of 25%. And I just believe that the people that are just hanging on to this, PPP or the stimulus, I believe there's going to be a lot of businesses that are not going to make it through this. And I believe that over time, it's going to trickle down to some of our tenant base. And I do believe that we're going to look at some delinquencies and more unemployment across the board. There may be people that were, renting our 3 bedrooms and families merging in on a unit. I mean, I don't know how bad it's going to be, but I'm nervous about that. And so kind of preparing a little bit for the worst case, but hoping for the best. That's my opinion.
And then maybe let me add one thing too. I'd like everyone to add to the answers. So what is that doing for you on the acquisition side? Is it changing your strategy? Is it changing your outlook? Or, you're investing for a 5-10 year horizon and, you could care less, right?
So when we bought when we closed on our last acquisition, we actually raised a rainy day fund that was put in the checking account. And so glad we did, because that's kind of our go-to in case, things get really, really tight. We haven't had to dip into that. But on a go-forward basis, we are raising money for a rainy day fund and for potential negative cash flows, and just keeping it in our entity account instead of the property management operating account. So we are underwriting a little differently because we're cautious. Top line, we're really not being aggressive on our rents in terms of rent growth, where we would normally see anywhere from a 3 to 6% rent growth. We're doing 1.5, sometimes flat. Sometimes we'll bring people right to where the market is today with no increase in year 2. So very conservative, which is really making it more difficult to buy deals. But I'd rather do that than buy a bad deal. But like I said, we had 3 deals under contract. So.
All right. Sounds good. Jason.
Yeah. Who's going to go next?
No, I mean, I think we all have a certain level of fear of the unknown, and that's okay. I mean, right. We none of us have a crystal ball, but I've been in this 20 years. Glenn, you've been in it 30 years. I mean, everybody else on the panel's been in a long time. I mean, the economic pendulum shifts back and forth. And I think, although we'll see delinquencies and we might see some tenants struggling, in a bad economy, home ownership is potentially going to decline. And a lot of those folks that own homes will now become renters. And so I think for the type of assets we're investing in, cash flow real estate, I think there's always going to be renters. I mean, we may have to expand our rental criteria, may have to be a little bit more forgiving with people paying rent on time. But I don't want to be, Pollyanna and just think everything's great. But, we're in B and C assets in a tertiary market, the Erie, Pennsylvanias, the Cleveland, Ohio's, the places like that, like the Rust Belt in the Midwest. I don't want to say it's not a worry, but, you should always stress test your deals. And if your deal can't withstand, 20% vacancy, then you shouldn't buy it, right? If your deal can't withstand holding back distributions to your investors, or, maybe you have to go out and lease your own apartments or mow your own lawns, whatever it takes. But I don't see a long-term disastrous thing happening. I mean, so many states are itching to get back to normal, and what is normal going to be like? I mean, who knows? I mean, hopefully at some point, we have sports and we have get-togethers and all these things, but it'll take time and more time in different parts of the country. But I think, we have a resilient asset class that we invest in, and I'm not losing too much sleep over, the top line revenue part of this business. And I'm certainly excited about the opportunities that'll come up and on the acquisition side, probably in about 6 to 12 months down the road.
Great. All right, Kenny, that puts you up next.
All right. So I guess I'm bullish on our economy. I think I think this is another 6 to 9 months, and then we're back to cruising again. Mostly because the stimulus stuff, like here in Texas, I went out to Melting Pot last Friday night, had a sit down dinner. It was full for 25% of the restaurant. But people were there, people were spending good money. There were, servers on the floor making money. So that was a good thing to see. And I think I got to go to my gym and work out this morning, thank God, finally. So anyways,
done without that workout, man.
Yeah, I know, man, it's been tough. Anyways, I think as we come back, it's going to be a fairly quick rebound. I don't know about a V, but I do think it's going to come back pretty quick because, in my opinion, most of the jobs lost were kind of the lower hourly people. And I think those are always the first to be fired, but they're also the first to be hired, right? And they're mostly plug and play. It's not this big training session you have to do for that stuff. So I guess I see it a little bit differently on that side of it. So I think we have a very, very short window here to lock up some deals that were unstable pre-COVID-19 and then also are out of money. Those two things have to be there for there to be a deal, because if you're like all of us, if we have a stable deal, are you guys selling right now? Absolutely not. So to me, the deals are going to be only for these really screwed up deals, mismanaged, all kinds of stuff. So we're looking, actually one of our properties there in Ohio, in the Midwest, to copy Ivan there. It's a neighbor, and we're about to sign a contract where we just take over their loan. And there it's 200 units. So I'm about to get 200 units for basically, no money at the closing. But it's about $1 million rehab. So as long as we can raise get the $1 million rehab, then we got a 200 unit asset. So I think those are going to be the deals that you see in the multifamily side in the next 6 to 9 months.
The deal that we have under contract now up in Fort Worth, it's only 65% occupied. So there are those opportunities for the people that have been sitting on the sidelines waiting, for, like the prices were so high in 19 and earlier in 2020, they're like, I can't pay that. Well, there's going to be some deals out there right now. So those are the ones you want to pounce on. You just got to underwrite them correctly and maybe a little conservatively, but you still want to own it when we get to the other side of COVID, right? Get past all that, because then your basis is so much lower. It's fantastic.
Well, yeah, and the low interest rates, right? We're going to have low interest rates for years, guys, because of this. So, which is always going to put pressure on the values going up and up, right? So, keep that in mind. You want to lock in your these hard assets today because inflation's going to set in. We've already pumped in more than double what they had in 08 and 09 of stimulus in this economy. It's going to be insane what rents are going to go to, in my opinion.
Yeah, I do believe that in the end, there's just going to be so much money there. Some sort of inflation is going to creep back. And there's also going to be a divide of wealth. That's where it becomes really interesting, because you're going to have a lot of equity that's looking to invest into something. Guess what? Multifamily is an attractive asset class. And so it's better than negative interest rates. And so leave it at that. All right, Raj, you want to go next?
Sure. So I agree with a lot of what Kenny said. I am not nearly as bullish on the economy as you are, Kenny. And here's why. I think, our economy traditionally, it's been about 70% consumption, and it's a lot. And I think consumption is going to be, I'll just say, permanently changed in terms of behavior, semi-permanently, permanently. If you look at, hospitality, travel, leisure, restaurants, sure, as the economy opens back up again and the local economies open up again, things will start getting better. But I think that's not accounting for behavior changes. I just think people are going to travel less. They're going to go out less. They're not going to go to, restaurants, not going to stay at hotels as much. And I think some of that's going to be long lasting. And because consumption is such a large part of our economy, even after everything opens up, I don't think we're going to get back to where we were pre-COVID. And I'm also, as I mentioned earlier, I'm concerned, unemployment goes for 26 weeks, and that's been a safety net for a lot of people, not to mention, the stimulus checks and whatnot. And at some point that ends, and there's, 30 million people that are out of work. And even if, let's just fast forward 6 months or 12 months, I think unemployment's still going to be high. It's not going to be hopefully where it is now, but it could still be 7, 8, 9%, 10%. These are huge, huge numbers. And so I think this is going to be a difficult recovery. I think it's going to be a longer recovery than what a lot of people think. And from a multifamily perspective, I think demand for Class B, Class C, C+ housing is going to be there because it's still some of the most affordable housing out there. But I think there's a real chance that rents may have to get cut for affordability reasons, potentially. And I think occupancy will probably stay high, but I think rents there's a good chance we may have to cut rents as incomes drop and continue dropping. From an acquisition standpoint, I'm not underwriting any rent increases at all, and then stress testing for rent decreases and seeing how it underwrites. I think, Kenny, you were saying like the debt is so cheap right now that's a mitigating factor, and it helps with the underwriting. So I'm kind of looking at trailing 3 cap rate on actuals and looking for at least a 3 to 3.5 point spread between that T3 cap rate and the interest rate on the debt. And that's just kind of one of my rules of thumb. And if that spread is there, then maybe the deal works.
Hey, Raj, are you still opening that restaurant?
Indian restaurant? Is that what you're saying?
Oh,
yeah.
I wasn't going to be racist. Jeez, Raj.
Well, I know you like Indian food, and you have a lot of Indian friends. So.
I leave it to Neil Bawa to be racist. I can't do it. I'm a white guy in the Midwest, age 42.
You can't get away with it, man.
No, I can't.
Well, I'm a Hispanic, and I love Indian food, if that helps.
It is so good. It is so good.
Love all foods equally, man, whether it's vegan, Hispanic. I eat it all the time. So. But no, that was good commentary. I mean, I think I'm probably in the middle between both of you. Kenny's really bullish, he thinks give him 2 months and everything's gonna be back to normal. Yeah, I think the problem is you have a lot of businesses that are gonna shut permanently. Whether it's the restaurant on the corner, how long does that take to come back, right? So that's kind of maybe the one thing I think no one mentioned, but I think I'm gonna let you kind of wrap that thought up. So you wanna go next?
Yeah, I'll go. Glenn gets to go first, but I get to go last.
I should have put you guys in the order. I feel like I would have had a good idea of how bullish or bearish each person is, and I could have just done like a ramp up. But
I'm doing what first of all I'm doing what Glenn does, and I keep a lot of cash and liquidity on hand, rainy day fund. You got to plan for the worst, especially if you're an investor and you're passively investing in deals like this. Like you need to have 6 months to a year of liquidity before you even call any of us, in my opinion. Yeah. But I might be more bullish than Kenny, and here's why. So, and I agree, Kenny. We've got a tight window to nab up some deals here before we see them melt up. So, all right, little Fed chair history here. Ben Bernanke, Janet Yellen, and now Fed Chair Powell. Ben Bernanke's famous nickname is Helicopter Ben because he got on Capitol Hill and said that he would drop money from a helicopter before he would ever let a 1929 deflationary depression ever set in again. Yellen, same school. Powell, same school. In fact, Powell got on last night on 60 Minutes and said that he's nowhere close to out of ammunition to get us through this deflationary crisis, which is not COVID, guys. Deflation has been happening for a long time, and central banks around the world are fighting it tooth and nail with money printing. This is a test run for UBI. If you haven't heard it yet, you heard it here first. Universal basic income, paying people that can't get a job because of Uber and technology is going to happen. People are going to get a check. And I'm thankful to be in multifamily because, again, I sit right behind food and water. Cash will equal trash. They're going to print the living shit out of cash. as much as they have to. And right now, I am trading in that toilet paper for income-producing assets that rise with the coming inflation from all the money printing. The cap rate spread. Right now, I'm buying on a cap rate in my market, 5.50. The 10-year Treasury is now at 60, 70 basis points. That's a 480 basis point spread before I add leverage. In 2008, that spread was 60 bips. We aren't even close. What happens when all of us are doing reasonably well, collecting rents, our residents are still getting checks or stimulus, or they're working from home, or a mix thereof? What happens when we get out of this and everybody wakes up to how well multifamily's done and interest rates are 150 basis points less than they were when we started? It's going to be harder to find deals because the pricing is going to go through the effing roof. Inflation is going to go through the roof. Now is the time to buy. And if you're sitting on the sidelines waiting for some 2008 vulture pricing, you're going to be on the sidelines for a very long time.
Amen.
Who's ready to buy a deal? Who's got that? Who's pumped up now? Anyone, I guess any of the panelists have anything to add to that? Now that we heard everyone's thoughts, now we can do a little bickering back and forth.
However, I could be wrong. So I could be wrong. So I also own a lot of gold, a lot of cash, and a lot of crypto. That's my portfolio, and operating companies like Kenny. I love operating companies.
Yeah. I think the last time I was on a panel, I was physically sitting with Raj on one side and Ivan on another. Yeah, so I love these guys, and they both have very strong opinions, and they're both very wise, but the interesting thing about this, and I think we all share this in common, providing housing for people, workforce housing is a good space to be in. And we can all talk about unemployment or the spreads and the cap rates or low interest rates, but at the end of the day, if you own these assets, and people, like you said, the hourly people are coming back to work, we're going to be okay. That's, I think, one message. We'll be okay. You'll be okay. As investors, we'll be okay. Will we make as much as we did in the past? Maybe not, due to various reasons and different markets. But
hey, Glenn, but we'll be making a much higher return than any other asset class if you include the volatility in the risk.
Without a doubt.
And you and I have access, in Kenny and everybody else, to the best debt on the planet, which allows us to lock in for extremely long maturities, which takes so much risk off the table, which no other real estate asset can do.
Yeah. Although I will tell you this, that right now, the deal that we're buying in Fort Worth, that I told you is only 60%, there's no agency available for that. And the bridge players are kind of skittish right now. Some have pulled off, some are, kind of capitalizing on it with more points up front and a little higher in interest rate. And
did you call my bridge guys that actually own the bank?
I think we did, and I think, Ivan, we're working with them. So thank you for that. So yeah.
Oh, it's my pleasure. They're not these bridge brokers, right? They've got their own publicly traded bank. Now, if you're listening to this and you've got less than 500 units, you don't have access to this. You got to get, and they like guys like Glenn with an operating company better. But there's some amazing debt available right now if you're a great operator and know what you're doing.
Yeah. So
that's going to be a great deal.
Yeah, that's what makes these panels and these events that these guys are hosting for us. And, that when Ferris and Garrison put all these deals or these Facebook Live shows together, there's a lot of resources and a lot of opinions that a lot of the listeners are going to capitalize on. So, again, kudos to you guys for putting these groups together. So,
well, I still owe Dave Tupin more than I could pay back for some advice that he came up with for my company. At a breakfast. So I'm equally thankful, Glenn.
Yeah, awesome.
So Ivan, question for you. Since you're bullish on things and on the asset class.
I'm bullish on B+, A-,
yep.
Midwest multifamily.
Sure. Okay. All right. Well, that's a little roar.
If you're opening a restaurant, I'm out.
So,
or a hotel. No hotels.
So do you think Do you think that cap rates are going to compress in that environment, or do you just think rents are going to go higher and NOI is going to go higher? What do you think?
I think cap rates actually have a very listen. I don't think 100% about anything, and I always hedge my bets. But I think cap rates on multifamily workforce housing, like 90s, early 2000s vintage, B plus, A minus. I think those cap rates are going to come down after this crisis subsides.
Okay.
Unfortunately, I hope I'm wrong.
Yeah, I think a lot of it will depend on access to the capital markets and to good, cheap debt, because
the big fish are going to eat the little fish, and the big fish are willing to take a lower return than me and Glenn and you. And when they start swimming around again, looking for risk-adjusted yield in a safe environment, they're going to be looking to gobble up more of what we're trying to get our hands on. And so right now they have to pause because of their shareholders and quarterlies and all this uncertainty. And so, sorry to cut you off, Raj. I'm with Kenny. I'm trying to get as much deal flow as I can, and I think you said it. My investors are trying to allocate more and rebalance their portfolio away from equities.
Yeah, and look, I think it's also very early, right? This is, although so many people have lost their jobs, but the stock market's now recovered, 65, 70% of the off the cliff type of drop that it had. And I feel pretty strongly that's going to go back down again, and it's going to freak people out again. But if more and more people lose their jobs, by the way, we didn't even talk about the virus. We have 90,000 people dead now. They're predicting 100,000 by June 1st. That's probably going to go to 200,000 or more over the summer. Hope not, but good chance that it will. And that's pretty bad, and that's pretty ugly. And I think I think where I maybe disagree is I don't see that optimism coming back, and I don't see that consumer confidence coming back for a long time. And I also I think people are going to think about the economy and about investments, and including real estate, as being in a riskier environment compared to a year ago. And I think because of that, they're going to demand higher cap rates and higher returns. And I think that's going to push values and prices downward.
But if you think real estate's going to be considered more risky, where's all that money going to flow? Right. What other option do they have in terms of, less risk?
Deleveraging, it'll go to pay off debt. Look at debt is at record levels, right? Corporate debt, all-time highs, right? Right. Look at the financial sector. There's so much debt. Obviously government debt, but people hoard cash when they get scared. And I don't know, Ivan, I think you talking about gold. I think that's probably a good play. But
gold's a good edge, but the Fed is going to punish you for putting cash in your mattress. They're literally going to beat you over the head and force you to get your cash out of the mattress and spend it.
Yeah, because you're not going to get paid for savings. That's for sure.
No, I get it, and the economy is going to change. People are going to live differently, but look at bike shops right now. Bike shops are out of supply, right? There's anecdotal evidence that the economy will come back. Again, it's anecdotal evidence, but if you see my front porch on a daily basis with the amount of packages with my wife's name on them, that she hasn't slowed down at all. Now, I live in a bubble. Obviously, I'm a very lucky, blessed guy. But this isn't an economic crisis in the financial sector. This isn't a demand crisis long term. It's a pandemic.
Yeah.
It's nothing like the Spanish flu. This thing's not going to be a V, but the economy will come back. And again, as it just relates to multifamily, A plus, B minus, maybe throw some C's in there. We sit right behind food and water.
Yeah.
We're seeing unsolicited.
And the government's shown that too, right? that's what they want people to spend their money on.
Government's back on our play. Kenny, sorry, I cut Kenny off.
No, that's all right. I was say we're seeing unsolicited offers for a lot of our A, B, and C class right now. People are, most of them have a New York City area code. I don't know if they're bored or just ready to get out of New York City, but to invest. But we're seeing unsolicited offers at pretty good pricing. There's no discount on the offers that we're seeing on our assets. So, I mean, we've got debt, we've got buyers out there, and we've got people paying rent. Like, I don't see this as a long-term,
Well, Katie, I think you bring up a good point. Texas, Ohio, Louisiana, Indiana, we haven't gone that far above the mean versus like a New York or a San Francisco, right? A Seattle. There's probably going to be some softness in some of these hot markets,
right?
That we're not going to experience.
No, and the other thing too is you get space in the Midwest and Texas, right? And there's an argument to be had about people are looking for more space now. But no, yeah. I mean, super insightful.
We're all buying below replacement costs too. Let's look at that.
Right.
That's very true. But no, I think super insightful information. I love the back and forth. That's always, to me, that's the most value of panels, right? Is kind of digging into Glenn's point earlier, right? Learning from each other what other people are doing, what's different, and kind of what's everyone's kind of perception of reality and the future, right?
Yeah, and in case Raj is right, I'm buying a lot of gold.
But way to double down, kind of make sure you're protected both ends. Hey, but any smart investor would, right? So,
yeah.
All right. Well, so with that said, we want to do something that we did last time that was super successful and really kind of let people have a little bit more of an intimate conversation with the panelists, right? And so what we're going to do is basically split up the entire group into how many channels do we want to do, Garrison? Want to do 8 or 10?
I'll do 9 to 10 people per room. That gives us 16 rooms. We're at 150 people on Zoom, and we have about another 80 people on Facebook that we'll just kind of go dead right now while we break off into our breakout rooms and try to conduct a normal style meetup with a little bit of networking.
Yeah. And so we will randomly split. So hopefully the splits, we get enough mix of the panelists in there. So we crossed our fingers. It worked out pretty well last time, but and then it's just an opportunity for people to get to ask panelists more questions. The panelists get to know the people better too, right? I mean, I had several people in my little group last time reach back out afterwards, and it was definitely it's a good way to have a real conversation.
A lot of fun.
Yeah.
Absolutely.
So, we're planning to do it for what, 10 minutes? Are we going to do 10 minutes?
Like 15 minutes, maybe 10, 15 minutes around there.
Okay, and then we're going to come back, right?
Then we'll come back and they'll do Q&A and wrap up.
We'll do it for 10 or 15 minutes and we'll all be back here. So if you're watching us on Facebook, just hold tight real quick, but we'll be back. If you are on Facebook and you want to hit the Zoom link in the Facebook chat, feel free and you can enter the conversations. But we will be back in 10 minutes. Right. Here we go. 1, 2, 3. Let's rock.
Hello. Hello. Hello.
Is that Sandra?
Is that Patricia?
Yes, it is. Hi there.
Patricia?
Hi.
I think everyone else is on mute. My name is Arlene.
That could be, yeah.
I think it looks like everyone's on mute, and I think everyone, I don't know if they were dropped off or they are just.
Well, it's all in separate rooms right now anyway. Do you know how this works?
Yeah, so
Yeah,
I
okay.
think we're all in a room together. If you look at your screen, there's about 20 of us in one room.
Oh.
And they're all on mute. So I'm thinking that they're all on mute. I don't know.
I'm thinking that he just put us in a little room, just you and me right now. Maybe there's a third party because, but I don't see anyone else.
Okay, Sandra's on. She
there you
unmuted.
are.
Hi, Sandra.
Hey. Hi,
So
Sandra.
she unmuted. I think everyone has to unmute.
Okay.
We're all in a room together, it looks like. But
I don't think so. I think we're in breakout rooms.
yeah. We're in a breakout room together. But I think the three of us are the only ones that are unmuted.
They did breakout rooms, and now everyone's taking a 10-minute break. They'll be back.
Okay.
So what did I miss? Because I just got here. I had issues with my laptop. And so did this just start or what's going on?
No, it's been going for, I don't know, 30 minutes. I don't know what time it is.
Shoot. Okay. Too bad. I missed it.
I just got in myself. I just got home from work.
Okay. Well, you work. That's good. I have not worked in 2 months, which is good actually.
Well, what's insane was I haven't worked since November, but then I got a job where I'm coming in to try to revamp a homeowners association. They're in great disarray. So they brought me on April 20th.
Oh, just in the middle of all this.
Yep.
Wow.
And
okay. Well, good for you.
So Rob is on here. We're each logged on separate in different rooms of the house.
Okay. That works.
Oh, he logged up. Because I was talking, and so he ran into another room.
No problem.
He'll be back on in a second. And so where are you with that lovely beach background?
Oh, I'm actually this. Let me show you my real background.
Yeah, you've got your virtual background going?
Yeah, I do. So how do I get rid of this? Let's see. Yeah, I'm in Nashville, Tennessee, so nothing like
Oh,
that. There we go.
nice.
That's my house behind it. Completely different. But I do
We're
like
all in different rooms right now. Garrison threw us all in different rooms for a minute.
Oh, that's what I was like, well, how many?
Breakout rooms. He created breakout rooms, and so we're all in breakout rooms right now.
When I left it, because I didn't. All right.
That's what you get for not paying attention.
Yeah.
So you're in Nashville. I know I was talking to him. So you're in Nashville, Tennessee. How's the weather there right now?
Today was iffy, but it's nice. It's not too hot, not too cold. Mild 70s.
Oh, that's nice. Yeah, we were like 90 today.
Oh, where did you say you are?
New Orleans.
Oh, yeah, big difference.
Yeah, lots of humidity. It's been ridiculous. So
Yeah.
You have to show the hair, right? That's good.
What?
I said you have to show the hair, right? Because it's good.
Well, I've had it up.
Why not?
And so that the clip, once I wear the clip for a while, I get a headache. So I got to take it down so my brain doesn't hurt so much.
I believe that. Yeah, that makes sense. So let me see if I close this. Okay.
So how many do we have in here? Let's see if I know. So Garrison's in here, but he's closed. Bethany's in here.
I'm Joe. I just joined.
Hey, Joe.
Hey,
Where are you from?
I was having some wacky internet, so I went upstairs in my house and I joined back, and I just realized I was in a room, and I heard someone talking about
thrown into a
Nashville.
room.
Yeah.
Yeah, I'm in Los Angeles.
Oh, okay.
Nice.
I came from Orange County. I escaped
okay.
California.
Oh, yeah. You know what? My first investment is I still have it. It's in East Nashville.
Okay. Yeah, that area is doing very well right now.
Yeah, well, you say that, and I got my property manager calls me. He's like, "Yeah, your tenant wants to know if they can go, but they're due for a lease renewal." He's like, "They want to know if they can go month to month." I was like, "Oh," because they were like the most solid ones I've had so far.
Yeah.
And they both work in the service industry, so what do you expect? Like they were saying on the panel, they were probably using the stimulus check just to cover last month.
Oh,
So
that's
we'll see,
Nope.
But yeah, Orange County's not. It's actually doing better than LA. I do real estate. I'm an agent out here too. And Orange County seems to be doing a little better than we are in LA County.
Right. I was with Keller Williams in Mission Viejo.
Oh, okay. I was with KW in Los Feliz, but now I'm with a company called Douglas Elliman, which is based in New York City, but kind of getting a, good run out here so far. They're actually, I think, my friend just moved to Nashville with Compass.
Right. Well, you guys have 13% taxes. We have 0 state taxes. Right.
Trust
there.
me.
I'm like,
I know. My relatives are in Memphis as well. My uncle, his kids, and I mean, they're in their 20s now, but they're all in Memphis. So that's how I kind of came about Nashville, because Memphis was like a little up and coming for me at the time.
Yeah, a lot of crime in Memphis. It's a different business.
Totally different market from Memphis to Nashville.
Yeah, it is.
Yeah, you know what? My uncle's wife went to what's the school in New Orleans? I heard you say New Orleans.
Loyola, Tulane.
Tulane. Yeah, his wife went there.
Yeah.
So I hate to say this, but can you give me an update of what they talked about in 2 minutes so I don't take too much of your time?
Oh, on the panel? It sounds like the one guy, Raj, seems pretty nervous about the future of the economy, I guess. And the other guys seem like they're pretty positive about it, right?
Okay.
Would you kind of go like, he seemed like he was just a little more skittish, I guess?
I didn't watch it, but knowing, I just got home from work, but knowing Kenny and Garrison, they're very much opportunistic. And so they're going to see the upcoming time as the time when real estate would be most readily captured from those who didn't properly vet the properties to begin with. So those who bought on slim margins, or they bought with
I am going to steal those exact properties you were talking about, young lady.
But if you bought with a complete value add, or if you bought with very slim margins, or you bought at a iffy cap rate, and your whole pro forma was based on, I'm going to raise rents, and now you're like, oh man, what am I going to do if I can't even collect the base rents? Or you based your pro forma on industry standard is 95. I'm going to be even worse and say 92. I'll have 92%, vacancy. And right now it's not how many empty units you have, it's how many non-paying units. So economic vacancy is what's going to kill you, which is the worst to have, because the tenants are just there sucking the life out of the unit. You're not getting any money for them. So what you do is, your market, what you're willing to pay, where you want to be, and you get ready to strike. Because I don't know about the rest of the world, but here everybody is service industry, and they had enough money, enough savings, enough stimulus to get them through April and May. They're going to be sucking air come June.
Yeah, well, you guys are closed, right? Because we're beginning to open up here.
Well, we opened up sort of. So the state of Louisiana opened up. Orleans Parish opened up with caveats, but it's still 25% of your total occupancy, and all that stuff. Yeah. And we used to say, this is New Orleans, you can't make us stop. But they found a way. Yeah. we had to stop.
Yeah.
They forced all the restaurants and the bars to close. Wow. There's like nobody in the French Quarter. Nobody.
And you have the Harrah's Casino, right? That's got to be,
Harrah's can reopen, same thing, but it's based on total square footage of the building. And so the facility is enormous. So they can operate at a pretty decent clip, even with the reduced occupancy, because the occupancy is based on square footage, based on fire marshal.
Right.
So if I've got a 40,000 square foot facility, I can still get quite a few people in that building every hour.
Hey, we're back.
Hey.
All right.
Hey.
Yeah, we are.
Nice chatting, Arlene.
We made it back.
Hey, everybody.
I hope everybody enjoyed the breakout rooms. Hope everybody got some networking done. We'll get Ferris and Powell back on here real quick. We'll end this thing with a real quick Q&A.
I was talking to myself.
And if you guys want to, any of the panelists want to push any products, Glenn, I want you to hold your book up, tell everybody where and how they can get it, and anything anybody else here has to offer.
Yeah,
Hey.
so, do people like the breakouts?
Yeah, that was fun.
Yeah,
It was cool.
Very one-on-one, yeah.
I went into the breakout room.
It's different, so definitely glad to have that. So
Breakouts are cool.
yeah. Hopefully you guys, not too many people got stuck in Ivan's.
Yeah, I kind of wanted to get stuck with Ivan or Garrison.
Wait, did any of the panelists did any room have 2 panelists or no?
No.
We did.
Oh, it worked out. All right, good.
Ferris, I'm pretty upset. I couldn't get anybody to invest in my restaurant syndication.
Go talk to
You're the
Rod.
chef?
That guy I think wants to open up a few restaurants. You should go talk to him. Yeah, I heard he makes some good food too. So. All right, awesome. Well, a lot of people enjoyed that, but yeah. So maybe, sorry, Garrison, to go back to what you were saying, you wanted to give all the panelists kind of a minute to just kind of reintroduce themselves, how people can reach out to them. You know, if you have a book, anything interesting you've done, definitely feel free to give it a shout out, and then we'll hop to Q&A. So we'll kind of wrap up the last 10-15 minutes with just open mic.
Absolutely. Glenn, tell me about your book, man. I already own a couple of them, but tell me all about it, my man.
Maintenance Man to Millionaire. You know, in my breakout section, one of the panelists said, "How did you get started?" And I actually had a whole section in there on my very first deal and how I really grew the company and bought 4,500 units. So that book's on Amazon. You could type in Maintenance Man to Millionaire, or you could type in Glenn Gonzalez. And if anybody wants to reach out to me, they can just go to email and glenn@obsidiancapitalco.com. And, you know, I love to network with folks and I love to answer questions. So that's me in a nutshell. And I love this stuff. I'm having so much fun. Thanks, you guys.
I love it,
Awesome.
Glenn.
Thank
Thank
you
you for being here, my man.
Thanks for having me. All
Who
right,
wants to hit it next? Kenny, how can we get a hold of you?
Yeah, guys, appreciate it. So I also have a book, Investing in the Dream. It's also on Amazon. Sold a few of those, and then
Your book doesn't have a really big hammerhead person on it.
I do not have a hammerhead person. I've got gold coins in the front. So anyways, best way to get a hold of us, guys, is at wolf with an e-investments.com. You can Google Kenny Wolf, will come up. We've got a YouTube channel. We do a weekly Q&A on Facebook as well. Whenever we can meet up again, Ferris and I and his partner, Ben, we run the MFIN conference as well. So we had 400 people in Houston at the last event. It was massive. It was awesome.
And who else did we have? I got to shout out to ourselves.
Okay. I'll leave some more. I'll leave some more for Ferris. But anyways, reach out. It was great to meet you. If I can help out, let me know.
The answer.
Hey, real quick. Kenny, Glenn, are either of you two raising any capital for any deals right now?
Yes, I'm, Kenny will probably tell you this. I am raising money on a new development deal, the ground up stuff. We had a great breakout session with our group asking about new development in the Austin area. And since I've got new developments, we're taking on investors on that deal. So
fantastic.
They can reach out to my website. They can register. They can actually download the offering right through the website. So
what's your website? I forget. What's your website name?
It's obsidiancapitalco.com. Yep.
Perfect.
Yeah.
Yep.
And Kenny, for you, I was saying the answer I was looking for was the mayor of Houston. That's what you missed.
So Garrison, we don't do 506Cs, so I can't publicly solicit. So we may or may not be raising capital at the moment.
Okay. Luckily, we're
Kenny Wolf is still 506B?
Hell yeah.
Wow. Dude, I'm jealous.
Yeah, I know, man. It's the way
Ivan, you're the only one I know that just sticks to the C's, man. I feel like this is the barrier of investors having to not be able to self-accredit is just painful. That's my thoughts on it. So.
No pain, no gain.
Yeah.
Fair enough. All right. With that said, so Ivan, you want to quickly say kind of how people can reach out to you?
Hey, thanks again, guys. This has been so much fun. Oh, somebody else needs to mute.
I'll go through and mute some people. Keep on talking, Ivan. I'm sorry.
Hey, Garrison, you can do no wrong, brother. Thanks for having me. I'm on my second tequila. I'm having a blast with you guys. This has been the best Monday night in a long time. I'm pretty easy to find if you spell my last name correctly. Ivan, B-A-R-R-A-T-T, Ivan Barrett, BarrettAssetManagement.com, B-A-R-R-A-T-T, 317-590-1978, 317-590-1978. Always raising capital for our Midwest apartment communities.
Awesome. Jason Pirro, what do you got going on, my man?
Hey, what's up, man? So yeah, I had a book that came out, or I had a guest chapter on a book. It's called Crash and Learn. Friend of mine, David Mamano, not a bunch of non-real estate people. And then I was a real estate guy in the book, but a bunch of stories about people that like nearly lost it all and like kind of kicked their asses, you know, to build it back. So, you know, in this kind of weird time might be some, you know, groups of inspirational stories that you guys can, you know, can get inspired by. You know, I was happy to be a part of that project. So it's on Amazon, Crash and Learn. It's got an orange cover. David Mamano was the organizer of that. So that was my first book project, and I have another one in the works. But reach me on PerroRealEstate.com. Anybody can text me if they want a network strategy session. Always have deals in the works if people want to learn about them. But my number is 814-397-8030, or hit me up on email, just first name, last name, jasonperro@yahoo.com. And I really enjoyed this tonight. A lot of fun, guys.
JASONPERO.
All right, Raj, you want to go next?
Yeah, sure. So best way to contact me is just through our new website. We actually just launched a new website. It's impactprosperity.com. My email is Raj, that's R-A-J, @impactprosperity.com. And I'd love to have you visit the site. And, you know, we have a newsletter that you can sign up for, and we can keep in touch.
All right, perfect. So then I guess with that said, man, let's open it up to questions. So if anyone asked a question earlier, I'm sorry, but I think we lost the history of it. So please retell you. It's an opportunity to practice typing faster. We're all working from home nowadays, right? So
can I say one thing, Ferris?
Go for it.
So during this call, I've talked to Kenneth, Raj. I'm going to reach out to Garrett, Glenn, you. Like, one thing I want to stress to your audience is all these guys are so accessible, and that's the best part about this is whether you're a passive investor or you're new in the business and you're just looking for advice. Like, all these guys on here, Jason, everybody, they're all so willing to deliver value and pay it forward because somebody did it for us. And so if you approach any of us in the right way, we're happy to give you 15, 20, 30 minutes, maybe even more of how we got to where we got to and how we did it. Because none of us started with a big check from somebody else. We all grinded, and somebody helped us. And so that's why we all have so much fun together, is because we're also open and willing to share. And that's what being in a mastermind is all about.
Well said, Ivan.
This is so much fun.
So true.
So,
I do got some questions.
But,
I do got some questions that people popped up, and I see them in they're in my history. I can see them. And maybe we can just ask them, and if you could just, not everybody needs to answer them, but if you could just fire off a quick answer so that way we can get through as many questions as we can. Is there anybody that has any underperforming assets, and what are they doing about it? That was a question from Michael. Anybody have anything that's underperforming? And
I can address that. I've got 2 deals down in Lake Jackson that are not performing. Very much supported on the gas and oil industry and the chemical companies. And they've had probably 4,000 or 5,000 furloughs and employee layoffs down in that one market, and suffering greatly down there. So
I do want to applaud you for answering that question. This goes back to what Ivan was saying earlier, right? Just being transparent and candid with the good, the bad, the ugly. So
it's easy to toot your horn when you're having a lot of success and making a lot of money, but you know, I mean, that's not always the case 100% of the time, and it's unfortunate. But
from our experience, the worst are the ones you learn the most from, right? And kind of
I do learn a lot, so for sure.
Yeah, I'll follow up, Glenn. We got a deal in 2015. It's our oldest asset. I would say our lowest rents in our portfolio. I'd call it a C+. They're definitely trailing behind everybody else. We're probably 7% collected on that one, you know, versus some of our newer, nicer stuff where people are working from home and have a little more stability. You know, it's a tricky business out there, and you know, C+ is a great place to start, but you really got to know your numbers and know how to manage that, because collections, whether it's COVID or not, can change on a dime.
Good, thank you. Okay, Rebecca Robertson asked, do you think it's wise to wait for deals or right now? And let me maybe address this too, for younger, newer type of investors. So not you guys who are investing in syndications for 200 units and things like that, but for somebody that's going to buy a 5 unit, a 10 unit, an 8 unit, something like that. Do you think it's wise to wait for deals right now, or do you think they should go ahead and look to purchase something right now?
I mean, I would definitely recommend waiting on that. There's just so much uncertainty right now. You know, just the 5 people on the panel all have different views, right? So, I mean, there's no telling, you know, which direction things are going to go. So I think if you're just getting started, my recommendation would be to wait a bit. I'm usually, by the way, a proponent of diving in and getting your first deal done, because I think that's how you learn the most. But I think these are just very unusual times, and I would just recommend waiting a few months and wait to just get some clarity on things. And the other thing is there's kind of very little pricing discovery right now. I mean, sellers and buyers are not on the same page, and so it's very hard to really know what any particular asset is valued at right now. Yeah. And so that's another reason to probably just wait.
You should be a little bit nervous about putting a deal together, but if you could buy a deal with a very, very low basis with also low leverage, you know, you might be pleasantly surprised when you get to the other side of COVID that you own a deal that you bought during the pandemic. When I say that basis is low compared to the market, let me just say, if stuff's trading in the 80s and you're able to pick one of these deals up that for 40 a door, you know what, I would say get on that. You know, I don't think you're going to find that deal out there, but if you do find one, like Raj said, the sellers aren't really, you know, letting stuff just go away. You know, we're not there yet, but if you can get it for a low basis with low leverage, I would say go for it.
If you find it and don't know how, come talk to one of the panels.
Yeah, just call me.
Yeah, just
give me a call.
Call me first, and I'll call Glenn and everyone else. All right.
Call me. It was my idea. You call me first.
I agree with Raj. You know, 8 to 10 units, if you don't really know your market and you don't know what the taxes and the insurance are going to be and how you can keep it rented, like, you know, that pendulum can swing on you pretty quick. Now, but I also think Glenn's got a good point. You know, now could be a really good time. And in 8 to 10 units, sellers often are expecting you to retrade the deal before closing. You know, when Glenn and I are buying, or Kenny or any of these guys, when we're buying 150, 200 units, we got to know what we're going to pay for them before we even put the LOI in, because we can't retrade. If we retrade, we're screwed, unless it's a really good, compelling reason. You got a party going on, Glenn. 8 to 10 units. 8 to 10 units, though. You know, those sellers, you know, more often expect you to retrade on the inspection, or if rents deteriorate, that kind of thing. So you might be able to tie up a pretty good deal and snag something.
Yeah, I think you need motivated sellers. So it's obviously there's deals to be had depending on the situation. But if you can find a situation where, to Glenn's point, low cost basis, you can get in cheap, and you have a motivated seller that's just for whatever reason desperate to sell, there's certainly deals that could be had, but those are going to be hard to find.
And know your market. I am wagging my finger for a reason. Know the market. Know the block. Know the school district. Know the market when you're buying 8 to 10.
So Ivan, we've had a number of different questions about that came up in the chat, and maybe not specifically for your guys' market, but maybe if you could talk for what size market you're looking at, or if it's tertiary or primary, like what size would make a good market, because I mean, a lot of people are asking, how do I choose a market and things like that, but maybe you guys could help with like.
But before we answer that one, actually, I want to be respectful of the panelists' time. Do you guys have another 10 minutes? Let's say that. Does that work? If anyone needs to hop off, I mean, feel free. Don't feel like you have to stay. It seems like there's a lot of questions that we have to run for another 10 minutes.
Sure.
I'm
All
good.
right. No one wants to hop off. then continue. So to Pal's question, does anyone want to take first stab at that?
It was again about markets and size of markets.
Yeah, just say you got to pick your markets carefully. Today, I don't know if I'd be buying in states that are still in lockdown. I think that's number one. But two, we always look for landlord friendly states and then kind of dial it in from there. Even in landlord friendly states, and I'll pick on these two cities I always do. I'm going to get nasty notes one day from Midland, Odessa. It's all oil and gas. So if you buy real estate in Midland, Odessa, you're really investing in the oil and gas business. If you're in Killeen, Texas, it's almost all military jobs. So you're in the military business. So look for who's employing your prospective resident base as well. I mean, that's a big deal. So you want a diversified economy. The smallest city we'd probably look at that's not attached to an MSA is maybe 50,000 people. Below that, you're getting pretty niche, and then it comes to who are you going to sell to, so.
The other thing that's a little tricky is one of the things that all of us normally look at is population growth and employment growth. And I think employment growth is going to be, significantly negative for just about every market in the country. And so you have to, you kind of have to reframe what you're looking for. So I think now, if I'm looking at a market and looking at what its unemployment is and what its population, maybe if it's a population decline, you want to compare it to something, right? Maybe what the state average is or what the national average is, just so you can make some kind of a relative assessment, because you're not going to see population growth now for a long time. Like these metrics are all going to show up as negative for quite a while.
Yeah, I think for us, we look, we've always just looked for stability. That's why like a Cleveland, Ohio is super attractive, or an Erie, Pennsylvania, or a Buffalo, New York. There's zero sexiness in terms of job growth and population growth in those areas. But the sexiness in those markets is what's happening right now. Like mid-COVID, like Kenny's got the bell of the ball with his deals in Cleveland, right? Like our deals in the Erie, there's no or very minimal disruption, not enough that even causes you to skip a beat. So for us, we're looking at areas that even with the worst economic upset since the Great Depression, there's not a whole lot of change in terms of people and their ability to pay rent. So that's what we look for in a market.
Anyone else?
Oh, all right.
This has been a lot of fun. Ferris, you guys rocked. You and Garrison, thank you.
Thank you for showing up, fellas. Thank you, Glenn. Thank you, Kenny. Thank you, Raj.
Yeah, thank you, guys.
Yeah.
Thank you, Jason.
Time out of your evenings.
Thank you.
I'm very lucky that I can consider all these people my friends. Thank everyone for joining us at MFM Live, Multifamily Masters Live. We will do the same thing in 2 weeks, Monday, 8:30 p.m. Reach out to each of these individuals. Each of these guys are my friends. Each of them are super helpful. If you have any questions whatsoever, if you're interested in investing, if you just want to hang out with good people doing good things, these are the kind of people you want to hang out with. If you want to learn real estate, if you want to network and hang out with awesome people and really learn the ins and outs of this business, reach out to Ferris, Power, myself. We have a Multifamily Masters Mastermind. With that being said, thank everybody. Have a great night. We had over 200 people on this call tonight, and you guys provided a tremendous wealth of knowledge. Thank you.
Thank you
guys, man. Definitely appreciate it. We're gonna do just a Zoom, the 6 of us hanging out sometime soon. So
yeah, that'd be fun.
Someday I'll see you guys in person.
All right.
It won't be too long. We'll all be back together. I miss you guys. Raj, great seeing you, buddy.
All right, man. Good to see you too, Glenn.
Thanks, guys.
Good seeing you all.